Before Q2 earnings drop, let's take a step back and ask, is Johnson & Johnson still the rock-solid dividend machine it's known to be, or are cracks starting to show beneath the surface? In this video, I'm breaking down the fundamentals and the key takeaways from J&J's Q1 2025 earnings. What's working, what's not, and what it all means if you're holding, buying, or thinking about adding before Q2. Let's sharpen your edge. Because investing blindly in a blue chip is still a risk if you don't know what's really going on under the hood. Established in 1886, Johnson & Johnson is a global leader in pharmaceuticals and medical devices. The company develops prescription medications for various therapeutic areas, including oncology, immunology, and neuroscience. Its medical devices portfolio encompasses products for surgery, orthopedics, and vision care. The company is currently offering a starting dividend yield of 3.34%, compared to its 5-year average of 2.77%. Its current price-to-earnings PE ratio stands at 14.7, which is below both its 5-year average of 16.2 and the sector average of around 15.9. Analysts estimate the fair value to be somewhere between $169 and $207, while the stock is currently trading around $155, suggesting that it may be undervalued at current levels. The company currently pays out $5.20 in dividends, distributed quarterly. The next dividend payment will be on September 10th, and it will be paid to everyone who holds the company's shares by August 27th at the latest. The most recent dividend increase was 4.8%. The 5-year average is 5.5%, and the 10-year average was 5.9%. A slight downward trend can be observed, but let's not forget that Johnson & Johnson has paid dividends every year for 109 years, and in the last 62 years they have increased the dividend every single year. The earnings payout ratio has regularly been below the expected 60% over the past 10 years. The free cash flow payout ratio experienced a 4-year fluctuation, exceeding the maximum limit, but based on expectations, this won't be an issue in the next 12 months. Both earnings per share and free cash flow per share have been steadily increasing year over year. There were some minor issues in the last 4 years, but hopefully the pattern will not continue and we will see 2 consecutive years of revenue growth. In contrast, free cash flow per share has been continuously increasing. As expected for a company like this, shares outstanding have been steadily decreasing, while the total sales chart shows consistent growth. Return on equity and return on invested capital have been well above the expected level, except for 1 year, and I believe this will remain the case in the future. The same can be seen in the operating and free cash flow margin charts. These are quite reassuring numbers. Now, let's talk about where most companies fail, if they haven't already: debt. Debt is very important in any company's life, and even as an individual, leveraging debt can lead to big gains if you are well informed or simply want to accelerate things, such as buying your first apartment or house. As we can see, Johnson & Johnson has no issues managing its debt properly, staying well below expected levels, so the interest coverage is flawless. The company is currently offering a starting dividend yield of 3.34%. The most recent dividend increase was 4.8%, and it holds an AAA credit rating, which is very strong. The dividend also appears to be very safe, suggesting that the company might be undervalued based on these factors. Let's jump into Johnson & Johnson's first quarter results for 2025. Revenue came in at $21.9 billion, up 2.4% year-over-year on a reported basis and 4.2% operationally. Adjusted EPS was 277, up 2.2% from last year. GAAP EPS came in at 454 cents, a 239% increase compared to last year, driven by one-time items and tax benefits. Free cash flow was approximately $3.4 billion, and J&J paid out $3 billion in dividends to shareholders. Innovative Medicine segment. Innovative Medicine generated $13.9 billion in revenue, a 4.2% operational increase. Oncology was the top performer, with strong sales growth from Darzalex, Erleada, and Tecvayli. The newly launched combination therapy Rybrevant Lazcluze showed a significant survival benefit over the standard of care in EGFR-mutated non-small cell lung cancer. In immunology, Tremfya performed well due to market share gains and its new Crohn's disease indication. Stelara and Imbruvica, however, declined due to biosimilar competition, and Medicare Part D redesign impacts. Neuroscience and other therapies. Spravato grew steadily thanks to increased demand from both physicians and patients. On the flip side, long-acting injectables like Invega Sustenna, Trinza, and Travicta declined due to the Part D changes. Medtech segment. Medtech brought in $8.22 billion in revenue, a 4.1% operational increase. Strong performance came from Shockwave Medical, Impeller devices and the vision segment, especially with the AcuView Oasis one-day lenses. Orthopedics, however, was impacted by one-time events, including fewer selling days and an ongoing transformation program. 2025 outlook. J&J raised its full-year revenue forecast to $91.6 to $92.4 billion, reflecting 3.8% operational growth at the midpoint. Adjusted EPS is expected to be between $10.50 and $10.70, a projected 6.2% growth from last year. They also indicated that the second half of 2025 will likely see faster growth as newly launched products gain momentum. The Intracellular Therapies acquisition is expected to contribute positively by year-end. Risks and headwinds. Stelara is facing increased biosimilar competition, and this is expected to accelerate as the year progresses. Other impacted products include Imbruvica, Tremfya, Uptravi and Iliada, mainly due to the Medicare Part D redesign. Pipeline and milestones. 2025 is shaping up to be a pivotal year for J&J's pipeline. Key developments include Capleta for major depressive disorder, Tremfya sub-Q for ulcerative colitis, Rybrevant sub-Q for lung cancer, and Icotrokinra, a first-in-class oral peptide for psoriasis and UC. Some of these drugs are projected to outperform current market expectations by 2 to 3x by 2028, according to internal forecasts. Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.